Hey guys, it's me, Vienna, your insurance exam teacher. I am here to help you pass the insurance exam. I am building this YouTube channel out. It's been a minute, I know, and I am sorry, but I am going to start doing this more regularly. Okay, guys, today I am going to be talking about non-forfeiture options. I sit down and I tutor people and they are so confused about non-forfeiture options. So I know this is a topic that is important to be covered, and I want to put it out here. And guys, just so you know, I tutor people one-on-one to help them pass the insurance exam. Every week, I have anywhere from 5 to 7 people passing the exam from all over the country. So, whatever state you're in, if you need help passing the insurance exam, I can help you. I have one on one tutoring sessions. I've put the link down below to get information. You can also follow me, DM me, set up a free 15-minute chat with me, and I will help you pass the insurance exam. I also have a group tutoring class that you can join me. You're going to get the study materials. Well, regardless of whether you do the one on one with me or join my group classes, you'll get study materials from me. You'll get a PDF with some testing and study routines, which is what is going to help you. You do not want to sit there try to memorize question after question after question because you're not going to see the same questions. You need to understand the ideas, the concepts, the programs, not the programs, the information. All right. So you need to understand the information so that when you go and take your test, you're going to sit there, you're going to be like, it's A, it's B, and you're going to know why. Okay, that is what I do. I help people understand this information. So, my group tutoring classes, we meet Tuesday, Wednesday, Thursdays from 7 p.m. to 8:30 Central. And we also meet on Saturdays from 9 a.m. to 12 noon. So, guys, and you get to join me for an entire month. You also have a program with all of the study materials. So, if the time isn't good for you, you can set up yourself and study on your own and whatnot. Or if for whatever reason y'all can't join weekdays or you can't come in on during the weekdays, during the weekends we review what we did during the week. Okay, guys, if you're interested in that, if you need help studying either one-on-ones or want to join my group or want some more resources, go to the links below this video so that you can get those resources that you need. Start studying with me if you'd like, but let's right now talk about the topic at hand. Let's talk about non-forfeiture options. Okay. Like I've said, I've tutored a lot of people that are studying to pass the insurance exam, and they are confused about non-forfeiture options. And I understand now why, because I've been going through some other resources and whatnot on here and on other platforms, and we are completely talking about different things sometimes. So there are people on here and whatnot that are telling us that certain options are non-forfeiture, and then other things are not. So today we're going to talk about which are your non-forfeiture options and what it means. And guys, I do have a PDF that you can download down here below. And it is the one that I'm about to be going over right now with you, breaking down your non-forfeiture options. And I feel that it's going to be really helpful. So if you are interested in getting that printable, go ahead and check out the link down here below in the description section. Now, let me go ahead and share my screen and let's start going over your non-forfeiture options. Give me a second, y'all, and let's go into the PDF. Okay, guys, so this right here is my entire PDF to help you learn the information that you need to get past your life and health insurance exam. I update this all of the time. If you're interested in this one, I do also sell this, so feel free to check that down below. Now, the page, and as you can see, guys, all the information you need. This is a workbook to help you pass your life and health insurance exam. So all the information you need to pass your insurance exam is here. Now, the PDF that is below for free is going to be this page right here. And as you can see, I am going to focus on my non-forfeiture options. Now, guys, in my one-on-one class, in my group tutoring class, and in my one-on-one sessions, this is the information we review. So if you're interested in receiving this PDF, like I said, book a one-on-one session with me, or go ahead and join my class, or you can purchase any one of my programs, and I will be giving you this PDF as well. And if you're not interested in it, you just kind of want to study it on your own, and you're like, I've got this, then awesome. I also have that option. You can purchase the PDF on its own. And guys, everything you need to pass the insurance exam is here. I've broken it down. It's easy to understand. And this, I'm always updating it. So always check in. All right. So here is our non-forfeiture option. Again, if you'd like this page, it's down there below. Feel free to go down, check for it, download this. All right. So non-forfeiture options. What are non-forfeiture options? Basically, when somebody decides to cancel a whole life insurance policy, only a whole life insurance policy, they are going to get some options about what to do with the cash value money. So whole life insurance policies, you've got your coverage, your $100,000 in death coverage, however much that may be, and you have a savings account. It's a 2-in-1 bundle. One price, one premium, you're going to pay your whole life policy, you're going to pay your coverage, and you're going to pay your savings account. Money in this savings account grows from the premium. So more money you put in premium, the higher that premium rate is, the more money is going to go into your savings account. One thing that drives me crazy on social media, people like to say out here that the money for cash value is coming from your death coverage. That is not the case. If you have a whole life insurance policy, your death coverage is going to be $100,000. That's fixed. It doesn't change. It doesn't move with the exception of 2 policies. And I'm not getting into that in this video. But just know that in other than in 2 whole life insurance policies, if you start your policy with $150,000, that's it. It doesn't move. It doesn't change. We do not pull money from that cash value. Sorry, we do not pull money from your death benefit and put it into the cash value. The cash value grows from the premium the customer pays each month, or bi-monthly, or not bi-monthly, bi-yearly, however often they're paying their premium, all right? Because they also get options. Again, not what this video is about. This video is about our non-forfeiture options. Let's say you have a customer who has a policy for 10 years. On that 10th year, for whatever reason, they decide they want to cancel their whole life insurance policy. And in those 10 years, maybe they've accumulated about $10,000 in cash value money. Probably real life, they'll have more than that, but we're going to make the numbers easy for our exam purposes and studying. All right, so in 10 years, they got $10,000 in that savings account, which is your cash value account. Now they want to cancel their policy, and we're going to ask them, all right, you can cancel. What do you want to do with your money? And guys, real quick right here, non-forfeiture options, again, you only get these. We only offer these to the customer when they are canceling their whole life policy. So that's number one. When are non-forfeiture options talked about with the customer? When are they offered to the customer? That may be a question on your exam. When they want to cancel a whole life insurance policy. Term policies don't have these because we don't have cash value or savings or anything in your term policies, right? Right. So anyways, we will give the customer in their policy a chart. By law, the companies have to include a chart that's going to give them the amount of their non-forfeiture options and tables for the first 20 years of their policy. So a minimum of 20 years. And guys, my PDF, you will see things that are bolded. So if you are studying this on your own, if you just want the PDF, the whole PDF, that's fine. But just be on the lookout for where I've underlined or given you like a hint. That right there in red, my 20 years right there, that is because that could be a question on the test. We need to include a non-forfeiture table in every single whole life policy for the first 20 years of the policy by law. Now, the companies can include it for beyond that point. 20-year minimum is what is asked of them. All right, so your customer is at year 10, and now we have 3 non-forfeiture options. I've been hearing people tell me about an acronym called CRAPO. I want you to get that out of your head. It doesn't work because 2 of those letters don't actually refer to non-forfeiture options, and I'm going to explain what those are. I've actually included that in this page. So again, if you'd like this PDF, if you'd like this page, the page is for free down below. If you want the whole PDF, that link's also going to be down there. All right. So guys, your non-forfeiture options are going to be the cash surrender value, cash surrender option. You can say that. The second one, we have 2 possible names for it, and the insurance exam likes to use these interchangeably. So we can say reduced paid up insurance, reduced paid up addition. You can say any of those terms. The insurance exam tends to use the red one. Another thing about my PDF, if I have an instance where I'm like, okay, this has this name and this name, guess what? The insurance exam may call it reduced paid up insurance on question 10, question 49. It may say reduced paid up addition. Now you think you have something different, but really you don't. Or in your answer options, it'll switch them up. So be on the lookout for that. And that's something that I always tell my students. And on my PDF, I do point it out. So if y'all see that little dash right there, and then the next one's in red, that is because it's the same thing, different names. All right. So your keyword here is reduced, paid up, either insurance or addition. It is the same option. But that is one more option we give them. That's going to be my R. And then the third one, and finally, you got 3 non-forfeiture options, guys, is going to be your extended term option. This one's the E, all right? And this is it. In a minute, we're going to talk about the rest of them, and we'll talk about that acronym. And we might make up a new acronym. So we'll just see, all right? So the first option that we give the customer, the first thing that we can tell them is we're canceling your coverage. You're not going to have any more coverage. You're completely done with us. We're completely done with you. The insurance company is like, bye, right? And they can just take their money after their cash surrender value is taken out of their total, and they get a paycheck, direct deposit, however the insurance company wants to give them their money. So for example, our customer has $10,000 in cash value. He's been our customer for 10 years. And the insurance company is going to look at him and say, okay, so if you want your cash surrender value option, that's fine. $10,000 is your total. We're going to subtract $2,000 because that is your cash surrender value at this point. The cash surrender value, the customer is giving up that money, the company keeps it as a penalty for canceling this policy. So the customer after that gets $8,000. So we're either going to cut him a check or a direct deposit, however the company wants to pay them out. Here, guys, there is no more coverage at all. We are cutting complete and total ties with the customer. The customer is requesting to renounce that policy. They're just giving it up and they're saying, give me my money. That's it. Cash surrender value, I get my cash. That's going to be my C. That's option 1 that the customer can do. Now, if we talk to our customer and maybe they don't want to lose their coverage, they can keep their coverage. We do have other options, but that is going to be your main thing, right? Option 1, no more customer. That's it. They're saying goodbye to us. We're saying goodbye to them. And that's that. My second option, y'all, reduced paid up insurance, reduced paid up addition. This one, we're going to do the same math. We've got $10,000 total. The company keeps their cash surrender. That always happens no matter what. Now we've got $8,000. We're going to tell the customer, would you like to have a whole life policy completely paid up, but your coverage is going to get reduced? Okay. And they say, yes, that's fine. They never have to pay a premium again. They're getting basically a lump sum payment, or I'm sorry, they are doing a single premium whole life insurance policy. We don't call it that, but that's essentially what it is. And this is just an option that the company is offering to your customer because they don't want to lose a customer. So instead of saying, all right, you've got a $200,000 coverage policy and you're paying this much, okay, you know what? For $8,000, we can give you a $50,000 whole life policy for the $8,000. So the company keeps the $8,000, one single payment. So it's a single premium payment option. And we're going to give your customer a coverage of $50,000 instead of that $200,000 they had. So they get to keep coverage in this amount. It's just going to be reduced, right? And they never have to pay a premium again. So that premium is paid up. Therefore, we have our paid up, reduced insurance, right? All of the names for these policies, riders, provisions, options are very straightforward and they're very much literal. We do not have to overthink them too much, guys. So if you read them the way that I teach them, if you do it slowly a couple of times, you will go ahead and memorize these and you'll be able to really look at these and say, okay, you know what? Literally, what is it telling me? What is it doing? Okay, so reduced paid up insurance, they are going to keep uninsurance policy. It's going to be a reduced amount from whatever they had before that they are canceling, and it's going to be completely paid up, right? So reduced paid up policy. So that is my option 2. That is my R in that acronym. And again, don't want you to remember that crapo acronym because it's including other things that are not non-forfeiture options. And I don't know how much I can stress that, y'all. But the next one is my extended term option. So my extended term option, basically like it sounds, in this case, we are going to do the same thing as we did in number 2, but in this option, we are giving the customer a term insurance policy. We are not reducing that benefit. The coverage amount is going to be the same as whatever they are canceling. The only thing is now it has a deadline, right? So for $8,000, we are going to tell the customer, all right, you have a $250,000 policy right now. That is your death coverage, right? And for $8,000, we can give you a $250,000 policy for 10 years or for 5 years or whatever it is. But basically, they keep the same amount of coverage. They are letting the company keep the $8,000 so they never have to pay a premium again. So it's paid up also, but it's a term policy and it will expire in maybe 5 years, 10 years, however long the company can afford to offer them that coverage, given their health and all of that, just like regular underwriting for that $8,000. And that's literally the options that they get, guys. They either cancel the policy completely and they get all their money, they get all the cash after the surrender value. They reduce their coverage and let the company keep those $8,000 because that is what essentially is happening. The company doesn't want to lose that money, doesn't want to lose that customer. So they're going to make these special options available for them. Hey, how would you like a different policy? Let us keep that $8,000 and we will give you a whole life policy for $10,000 in coverage, but it's completely paid up. All right. So it's basically, again, that single premium whole life option for a much smaller amount in coverage. That is my number 2 option. Or, okay, let us keep your $8,000 and we're going to give you a term policy for the same amount of coverage. So what does the customer want to do in this case? And again, guys, these are our options. These 3 in black right here are my non-forfeiture options. People out here are saying there are 5, sometimes that there are 4, but nope, there are 3. Okay, so these are your non-forfeiture options. As far as an acronym for non-forfeiture, I would say REC, maybe REC, like recreation, like rec, like it's fun. I don't know, maybe it's fun. You can think about getting some money. CRE, I don't know. Y'all can come up with your own acronyms, drop them down in the comments. Tell me if you like REC. That's the only one that I can really think of. CRE is something, and I can't think of what that is. Maybe y'all know what CRE stands for. Tell me down in the comments because I don't know. But these are your non-forfeiture options. This is what I want you to know as far as your non-forfeiture options. And guys, this is important because this does come up on the test. And don't forget, if you want the PDF, this page is down here below, so feel free to download that. Okay, guys, so here are the ones that people think are non-forfeiture options, but are not non-forfeiture options. These are the ones that make up that acronym CRAPO. And guys, honestly, I have no idea what that O stands for. Maybe options. I don't know because I researched and researched and researched for this just to make sure that I wasn't wrong. And I didn't find anything with an O. So anyways, maybe the O is options. I don't know. But anyways, if you want to build that acronym, and we're going to talk about the ones that are not non-forfeiture options, but are provisions in a policy. Provisions are different, guys. Provisions give you details of a policy. Provisions are mandated typically by law, and in every state, some are state mandated, but a provision gives you a detail. When we talk about provisions, riders, and exclusions exclude things, riders add, and provisions give you the details. So this right here is going to give you the details about what will happen if X happens. All right, and these are mandated. These are already built into policies for the most part, and we don't need to think about them. We just need to really understand, does your policy carry it? And this is going to tell you the details about what's going to happen. So provisions give you details. These are not non-forfeiture options. Neither of these are talking about canceling a policy or happen when a customer is intentionally wanting to cancel a policy. Non-forfeiture options happen when a customer intentionally wants to cancel the policy. All right. The first one is the A. So our automatic loan provision. This one, guys, only is offered on universal life insurance policies. Universal life insurance policies are whole life policies. And in this one, it is special because universal life insurance policies, that cash value is 100% in the stock market. All of that money is in the stock market. Okay, that's what I want you to remember about universal life policies. So in this specific type of a whole life policy, the customer, let's say they end up not being able to pay their premium 1 month, they miss their premium, a grace period is going to get kicked in. And now, if I'm on my grace period and I miss my second premium, I don't pay it the very next day, what's going to happen is the company automatically takes money from that cash value account, pays that premium so that the customer does not lose their policy. It is meant to keep the policy active and in force to help the customer out. When that happens, it is considered a loan, so they are going to eventually ask the customer to pay that back into that policy, and interest accrues on that loan. But every time after that your customer doesn't pay their premium, this is going to kick off and it'll get paid automatically. So it's there to help your customer out if they have it in their policy. And again, only universal life policies are eligible for this provision, not all of them, right? So that is my A in CRAPO, although again, the A, not a non-forfeiture option, but it is a provision in policies. The next one, the P, provision, this is paid up additions. This, again, this is only on whole life policies because, of course, on your term policies, that's only coverage, pure insurance, does not build up savings accounts. So that's only your death coverage. So we don't even talk about all that when it comes to term policies, right? So here, guys, paid up additions, do not confuse them with your reduced paid up addition. Here we are reducing policies. Again, this one, we give it to the customer when they want to intentionally cancel their policy, right? That is my non-forfeiture. My paid up additions, this one, think about what it sounds like, paid up addition. This is additional premium that the customer can choose to let the company keep and pay towards their policy. What a paid up addition is if your whole life policy is the type of whole life policy that receives dividends, and only companies from mutual insurance companies receive dividends if they have a specific rider on them. Okay, guys, sorry, not a rider, a provision, but that's not what this video is about. So just know that not every whole life insurance policy does receive dividends, but if yours happens to receive dividends, and one specific year you get dividends on your policy, they're going to ask you, what would you like to do with that dividends? Would you like to receive it? Do you want it in a check or direct deposit, or however they choose to pay it? Or would you allow the insurance company to keep it and pay towards your premium? So that is basically what that paid up addition is. If you decide to let the insurance company keep it that year, they keep it, they apply it towards your premium. This is extra premium, and what it's doing is it's going to increase the death benefit by whatever the amount may be, and it's also going to increase your cash value. And it increases the cash value because, like I said a minute ago, your cash value grows based on how much premium you pay. So the more premium we pay, the more that cash value, that savings account grows. So that is what your paid up addition is. It happens throughout the policy years. Every time the company decides, hey, we're going to be cool this year and give dividends to our customers. Okay, so if that company decided this year they're not going to pay dividends, then nothing happens. But when it does, this is one of the options your customer gets. But it is not a non-forfeiture option because in this case, we're not canceling the policy. All right. Okay, guys, so that right there, again, this is what your non-forfeiture options are. If you are interested in this PDF in this page, feel free to download it below. If you are interested in getting tutored with me to help you pass the insurance exam, I do offer one-on-one tutoring sessions. I also have a group class that you can come in and join. I also have this PDF complete that you can purchase down below. Feel free to check them out. Feel free to set up a free 15-minute chat with me to talk about the tutoring options. I'm here to answer your questions, so leave them down in the comments as well. And don't forget to follow me. Don't forget to subscribe. And I just want to say thank you for watching. Thank you for letting me help you understand this very important topic for the insurance exam. Leave your comments down below. All right, because I'm excited to know what they are, and I am excited to see you pass the exam. So leave me all of that information down below, guys.
I'm not sure my bumper is moving off the way. Error number 6.